Welcome back to a third part of our episode on lease accounting. This is where we get in sort of the nuances of what's this about, how come, whys, how to fix it, how to get out of it, how to work around it. We want to get an understanding of what it's really doing. And I do want to do one more shout out though to Morris Media for making these podcasts possible. And this is fun to come and do this. And you're going to learn more about Haas and Dawe debits and credits. And we're going to dig into some of this accounting world that we have to deal with to explain to clients because we all are frustrated by the lease accounting standard. So let's dig into what's new about lease accounting relative to how it really works and what the meat of the standards is all about. So it's talking about leases. Now that's an easy concept is you rent an apartment or you rent a car or you go in and you have a copy machine in your office and you're paying a lease payment on that. But when you drill down to it, it's all about a contract. The lease is a contract. And when lease accounting came into existence, when they developed the standard back in 2014, it was about a contract. And if there was a contract, then you had a lease. If there was no contract, there's no lease, and lease accounting doesn't apply. It's a sort of a nuance because there were other standards they were coming up with at the same time. One had to do with revenue recognition and how to make sure the companies were reporting the right amount of revenue. Because it's interesting when the big publicly traded companies FASB, that's the Financial Accounting Standards Board, was concerned about people trying to accelerate revenue to make the reports look better. When then get down to our clients' world, where they're smaller companies, they're trying to find ways not to report revenue because they didn't want to pay the taxes. So that's where they got into this concept of contract with revenue recognition and now contract relative to the lease accounting standard. Now, how to deal with the standard? Well, if you don't have a contract, you don't have to follow the standard. Meaning, then at this point, if there's no lease, then it doesn't affect the balance sheet. It doesn't go on. There's nothing to go under current liabilities, and you're not going to run into this problem of the regulatory covenant we talked about in our last episode of Section 17210 of having so much in the way of liquid assets, cash minus current liabilities. For leases have to be recorded if it's a legally enforceable contract, if there are legally enforceable terms within the document. As you said, if there's no lease, there's no legally enforceable anything. It's month to month type of situation. Or if it's related party. So let's say that I own the building that our company is in, and I choose not to have a lease. The company pays rent every month, but there's no lease document. That means there's no legally enforceable term because there's no contract, which means that we don't have to follow the lease accounting standard relative to financial statements. We do. And so this is something where, so let's say, or we have a second company, and let's say it's the escrow company, and so it's the Michael Haas escrow company, and I have to follow all these auditing rules, and it's regulated by the Department of Financial Protection and Innovation, and I don't want to mess that up. But I set up another company called Michael Haas Subsidiary. And the lease is in the name of this subsidiary. The lease is in the name of this related party company. And then there's just a lease back relationship, like the concept of a subcontract or a sublease between the other company and the escrow company. But there's no actual lease. It's just an understanding of it's month to month. So there's no sublease that exists between the escrow company and the other company. Again, no lease, no contract. No lease accounting rules have to be followed. And so it's something that is have to be careful about if there's a way to get out of the lease. And it seems contrary to 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 take a position of we're trying to find a way to get out of the standard, but because of the impact on the regulatory covenants, it makes it something that needs to be taken seriously. Not being done in a nefarious way or to subrogate any type of responsibility and so on, but just to try and take that burden off the financial statement that doesn't need to be there because it is affecting the liquid asset liquidity requirement. Now, where let's say a lease does exist and it's an audited escrow company. But let's say the payments are variable. And so if it has a variable term to it, then that's a way that now that um, gets you out of, or where the lease accounting standard gets applied so much differently and doesn't create this issue. Now, an example of a variable lease is where, and you see it very commonly with retail, where you have a storefront type of entity, or a retail store type of entity, where the lease amount is tied to gross receipts. So there may be a flat base rate that's very low, but then if the company is more successful because there's more foot traffic, more inventory, et cetera, and so it's going to be, what are the gross receipts? And that's how the lease payment is calculated. It's called a variable lease arrangement. And so it gets into the situation of, can you structure the lease that way? Can you come up with where for whatever reason, even if it's a related party, a lease is necessary. Maybe there's a loan contract involved as well. But if you can come up and word the lease with these variable terms, we're going to pay whatever a percentage of whatever gross receipts were prior month, then that's something that can take away the pressure of having to do the reporting under the lease accounting standard. And I guess an easier way to look at it is that your future rent payments can't be recorded because we don't know what the future rent payments are, because it's a variable payment that can change from month to month. Therefore, nobody really knows what the next 12 months of lease payments are going to be. Now, how do how do lease how do the lease payments get recorded? Like we talked a little bit about last episode, it's a math formula. Here's there's a lot of software platforms out there that will help you calculate this. It's coming up with an embedded interest rate, uh, uh, the time value of money concept. There are parts within the standard that give you ways to not have to go into detailed and deep dive of calculations, but there are ways to find ways, practical expedients, they call them, to get out of the massive calculations of lease accounting. Um, and so there are ways to help smaller companies move through this a little bit faster. Now, um, present value of lease payments, it gets discounted. That's the whole point of present value, is there's a discount rate involved. One of them is there may very well be in the lease, depending on the detail of the lease. It may be an auto lease, it may be an equipment lease, where the interest rate is already stated in the lease, and that's the interest rate one would use. But there's also something known as the United States risk-free rate, and that's something that allows, as an expedient, allow people to come up with a rate to use in trying to calculate the lease. Because let's rewind a little bit and talk about what used to be what they call the capital lease, is now being called a financing lease. So let's say you buy a piece of equipment. Let's say you buy a copier, and it's a big copier that can do copying and scanning and faxing and so on. And you get into this arrangement that it's 3-year term, and you pay $500 a month for 3 years, and at the end of the third year, you have to just pay $1, and you now own the piece of equipment. Well, they used to call that a capital lease, or now we call it a financing lease, because in effect, you're not borrowing the use of the property, you're buying the use of the property. So you're buying that copier. They call it a lease because it's a way that they trying to do the maneuvering within their systems of it being a lease versus a piece of equipment, but it's really a purchase, because it has a bargain purchase buyout at the end. And if you had to buy it at a fair market value, that's a difference. That's not where you're buying the asset until the very end you make the decision to buy it. But if this is a case where it has the $1 buyout, or a very low discounted buyout, then that's really a purchase. I don't want to say a disguised purchase, but it's really a disguised purchase contract versus a lease. And so we treat that a little bit differently in how it's classified. But that type of an agreement, this financing arrangement for the purchase, has always had an interest rate factor into it. Because what we used to do it is, we were told at the beginning of the lease the piece of equipment was worth, let's say, $10,000. And so what you would do, we would calculate back, okay, if it's going to be $500 a month for 3 years, okay, that's an $18,000 worth of payments over 3 years. And so we would do the math and run it backwards is, okay, what interest rate would cause there to be $500 a month payments on 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 a $500 a month payments on a piece of equipment that costs $10,000 that you're paying 18,000 on, what interest rate would cause that the math to work? And so that's how this when we say interest rate stated in the lease, it's sort of embedded in the lease that we pull out, and that's the rate we would use though to do the lease accounting standard and hitting the balance sheet. So we've talked with the people at FASB about related party leases and other ways to find relief from the standard, and they said yes. We specifically did not address related party standards. And we always get a little bit worried when we ask a question of somebody who's a regulatory body of some sort. In this case, FASB writes our accounting standards, and asking a question, we're thinking, oh, did they really think about that? Because we don't want to give them an idea they hadn't thought about, and all of a sudden, then they take something away that we thought we had a free ride with. Well, they said specifically related party leases we address by not addressing them, and we understand them. We understand about variable lease arrangements. That would be something that would be outside the scope of the standard. We also thought about other ways that people can have situations that can be affecting what's being paid, not being paid, like materiality. It could be that the monthly lease payment is $42 a month, and it could be that the overall value of the lease is $1,200 over the 3 years. That's immaterial relative to the balance sheet. And most of the standards that have come out from FASB dealing with accounting and how we book things and disclose things and record items and so on, they have said that materiality is a concern or an issue or something to be taken into consideration. And anything that's below a certain materiality level does not have to be booked according to the lease accounting standard. So this came about 3 years ago, and it still created some havoc for our clients because of the fact that we have clients who are not meeting the regulatory covenant because of lease accounting, because it's creating such a large amount under current liabilities that is pushing the client out of compliance. Now, the regulatory bodies, DFPI for independent escrow, the DOI for the title companies and the underwritten title companies, um, they're not doing anything about it as far as giving any relief from the standard, but they are being very patient. And they are taking into consideration that somebody was in compliance and now they're not in compliance because of this standard. They're giving people a little more time to work out the issue. But they're not coming along and saying, well, we're going to give you a free ride. It had been contemplated going back to 2016, 2017 by the DFPI that they would carve out the liability for leases, current liability number. They would carve it out and have the company do its liquidity computation, not including that lease accounting liability in the current liability section. But that never made it past the drafting stage, and the governor, in fact, vetoed a bill saying that the standards are there, everybody has to follow the standards, and so it's something where it didn't move forward. So we're continuing to talk with FASB about it. In some ways, I guess it's a good thing they know who we are. But in some ways, I'm not sure it's a good thing they know who we are because they know who we are because I've been crabbing about the lease accounting standard for going on 12 years now. But they're patient and we talk about it and we come up with suggestions and ideas and contemplating changes. And while they said that 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 the accounting standard update 842 on leases is not going to get repealed, it's not going away. They're not going back to the old rules, but they are working with what we call the Private Company Council, PCC, that to come up with maybe there's a carve out, maybe there's an exception, an exclusion, a resolution with the smaller non-publicly traded companies to how they can address the lease accounting standard where it's not going to be injurious to the audited balance sheets of escrow companies and the underwritten title companies and so on. So we'll see what happens with GUARD. It's with that topic. It's an ongoing process. It's a work in progress, we'll say. And we do have an open communication with the people at FASB and with the liaisons, with the private company council and so on. So it's positive. It's moving in the positive direction. Is it going to be anything this year? Probably not. Maybe for 2027, by the time it would, if something gets put into place from a conversation to the point to an agenda item, to the point it gets thought out of and evaluated and voted and so on under due process, then we can see. For right now, lease accounting is here. It's not going anywhere in the immediate future. We'll deal with it. We'll address it. We'll massage it. Variable lease contracts, related party leases, subcontracts that don't exist. There's all over the place. So as much as accounting is supposed to be a science, as my dad would say, it's more of an art. And we can find out ways we can maneuver and repaint and so on. So we'll close out with the lease accounting for today, and we'll get back with more episodes on the debits and credits with Haas and Dawe for a future podcast seating. Good to see you again today. Have a great day. We'll talk to you later. Bye bye.